Interest-bearing trust accounts. Let's assume your buyer is putting down $100,000 in earnest money. The transaction is going to take 10 months to close. The buyer would like to receive interest on this money as it sits in your principal broker's trust account. Is this allowed? We mentioned at the beginning of this chapter that trust accounts must be non-interest bearing by default. However, as we've reviewed many examples, you've seen how most of the rules may be altered if agreed upon by both parties. The interest-bearing rule is one of those rules. Upon request by one of the parties involved, the principal broker holding an earnest money deposit may place the deposit in an interest-bearing trust account. In order to do this, the principal broker must comply with the following restrictions. All parties must agree in writing. The document in which the parties agree to have the money placed in an interest-bearing trust account must designate how the interest is to be dispersed. The money must be placed in a special interest-bearing trust account separate from the regular trust account of the principal broker. One more exception exists to the interest-bearing rules. A principal broker may elect to have their entire trust account interest-bearing, with the interest being paid to a nonprofit organization. The nonprofit organization must have the exclusive purpose of providing grants to affordable housing programs in the state of Utah. The Division of Real Estate must be notified of the location and account number of the trust account. Most standard listing and agency agreements may contain clauses authorizing the broker to place earnest money deposits in an interest-bearing trust account with the intent of benefiting a nonprofit organization. Managing the trust account. We will now discuss the day-to-day requirements and procedures for managing and administering a trust account. The first requirement we should mention is the actual name of the account. The name on the account should be the brokerage name. Included in the account name should be the words Real Estate Trust Account or Property Management Trust Account. The full name of the account must be on all checks, and all checks written on the trust account must be numbered. Each check and each deposit slip used for the trust account must note the transaction, including the transaction number for which the check or deposit is being processed. Duplicate deposit slips must be kept, and individual ledgers on client accounts must be maintained. Brokerages may have as many trust accounts as they wish. However, the Division of Real Estate must be notified as to the location and account number of any and all trust accounts to be used. The trust account must be reconciled at least monthly. It is important to remember the real estate trust account is for the client's money only. Mixing client's money and non-client's money is called commingling and is against the rules. However, the rules do allow the broker to include up to $500 of their own money to cover incidental account expenses. Let's review some examples of when the $500 limit becomes important. A broker deposits a $2,000 earnest money check on the Jones transaction into their trust account, which previously had a zero balance. This is the first time the broker has used the trust account and they need to order checks for the account. The broker contacts the bank and orders checks, which costs $30. A review of the trust account balance yields the chart below. Brokerage funds, $0. Jones, $2,000, total $2,000 in the balance. When the bank charges the account for the checks, the money will come directly out of the trust account. Because the only money currently in the trust account is the earnest money deposit on the Jones transaction, the $30 will come off the Jones earnest money. As soon as any of the Jones earnest money is used for anything but the Jones transaction, the principal broker is guilty of commingling and has violated Utah rules. Let's review an example of how it's supposed to work. The principal broker should deposit some of their own money, up to $500, to cover incidental account expenses. Let's assume our broker deposits the maximum $500. The chart below represents the account balance. Brokerage funds, $500. Jones, $2,000. Total, $2,500. Please note, the subaccounts are in the records of the principal broker only. the bank does not recognize the breakdown of the trust account. If you were to contact the bank in this situation, all they would know is that the account has a balance of $2,500. The sub-accounts are simply a function of the principal broker's record keeping. When the bank charges the account $30 for the checks, the money does not need to come from the Jones earnest money. It may now come from the brokerage funds. For record-keeping purposes, the broker should take the $30 from the brokerage funds, yielding the balances below. Brokerage funds, $470, Jones, $2,000, total $2,470. What if the broker deposited $1,000 of their own money into the real estate trust account? Would this be allowed? No. The rules specifically state the broker is only allowed to have up to $500 of their own money in the trust account at any time.